Welcome back, everybody. In this video, we're going to talk about my 4 top stocks for 2024. And just to be clear, these are stocks that I actually hold in my own portfolio. So I actually have some skin in the game with these picks, and they're not just 4 random stocks that I pulled out of thin air that I'll just forget about next week. Now, in terms of what criteria I'm using to make these stocks top picks for me, it's pretty simple, actually. Number 1, they're stocks that I believe are quality businesses, which should obviously be a given if I've already added them to my portfolio. But the point here is that they're not going to be any meme stocks or any momentum swing trade stocks. And number 2, they're stocks that I expect to beat analyst expectations in 2024, because in order to outperform, it generally has to do with exceeding the expectations that the market already has for the stock. And number 3, stocks that are trading at good value based on their own history. Now, what good value means is going to depend on each individual stock. But the idea is that the stock has some opportunity for multiple expansion in 2024. All right, so now that you know what we're doing, let's get started. Stock number 1, Hershey. Now, Hershey is currently less than 1% of my portfolio, as I've just started adding it towards the end of 2023. So I don't have a ton of skin in the game on this one yet, but it's just getting started. In terms of performance in my portfolio, it's currently at less than 1% because it's so new. So again, this is really a new position in my account, but I do plan on continuing to add to it. And now if we look at how they performed in 2023, Hershey had a negative 16.2% total return compared to the over 26% total return of the S&P 500. And the crazy part is, in May of last year, Hershey was actually up over 20% on the year, crushing the S&P 500. But then it proceeded to lose about 30% of its total value from May to the end of the year. But why is that? And this is where researching stocks becomes a little bit more art than science. Because depending on your research, you're going to come up with different things. Some think it's commodity prices for cocoa and sugar, which reached all-time highs in 2023. And I think this obviously has some merit because those are input costs into Hershey's products. And it's something that they've actually discussed on their earnings calls as well. Now, others have talked about increased use of GLP-1 drugs like Ozempic and how that'll reduce people's appetites and thus sales for Hershey's products. But to me, this is more theory than reality because with less than 1% of US adults on the drug, even if the growth rate is astronomical right now, I just don't see it as a material issue. And some think it has to do with inflation issues, with consumers having less to spend and Hershey raising prices like every other packaged good company, and that's put pressure on sales. And this is something that we can definitely see in the numbers. Overall volume and mix is down, but they've made up for it with pricing. So on one hand, it's good to know that they at least have enough pricing power to be able to increase revenue even when volumes are down. But still, at some point, price increases have a limit, and that definitely is a concern going forward. And others think it's increased competition from the likes of Mr. Beast and Feastables. Now, I touched on this in more depth in my dedicated Hershey video, but I just don't see the tangible evidence that Feastables is a legitimate worry for Hershey at this point in time. Plus, Feastables has to deal with the same other headwinds of commodity prices, GLP-1 drugs, and inflation or pricing, and in some cases, it's actually a bigger issue for them since a Feastables bar is about twice the cost of a Hershey bar, at least in my local Walmart. Now, ultimately, I think the answer could be a little bit of all those, to be honest. It could simply be that in May of this year, Hershey was at an over 30 price-to-earnings ratio, where they came off of huge increases in sales growth over 2021 and 2022, which, from an outlook perspective, were going to be impossible to match. With their commodity input costs at all-time highs, softening outlook based on their guidance for low single-digit sales growth, plus all those factors that we just talked about, and people probably question whether or not there was real opportunity there. But if we dig a little deeper, there are a few that I don't really hear people talk about a lot as it relates to Hershey that I actually think are positive opportunities going forward. And first, Hershey's invested in increased operational capacity that they're expecting to get them to optimal service levels in 2024. They have salty snacks growth that's been good, with both Skinny Pop and Dots Pretzels being brands that have done extremely well. Plus, international sales is still an area where Hershey can improve, so even if they get to a saturation point in the US, there are some other options. Now, real quick, if we take a look at some of their performance metrics, we see a couple good trends. Now, first, continuing to improve margins. In general, Hershey's margins are good already, but if they expect sales growth to slow, then improving margins can help ensure continued earnings growth at higher levels than revenue growth. And another area is capital expenditures. Hershey had elevated CapEx in 2023 as they invested in operational capacity. Now, they expect CapEx to be lower, but still slightly elevated in 2024, and then they get back to a more normal level after that. Now, the reason that's important is because reduced CapEx should give them more free cash flow to reward shareholders with. And that's where the third one comes in. share buybacks. Now, Hershey did about $300 million in share buybacks over the past year or so, and that's something that I would expect to ramp up in 2024 as their free cash flow becomes higher and their share price is at attractive levels. They even discussed that possibility in their last earnings call. And obviously, share buybacks help improve overall earnings per share. So again, it's a lever they can use to meet expectations going forward, even if they have slowing sales. And let's talk about what those expectations are. In March of 2023, Hershey said they expect 7 to 8% earnings per share growth in 2024 and 2025. But since then, with everything that's gone on in the market and the increase in commodity prices, pretty much every analyst expects them to revise that number down in their next earnings call. So if you look at the analyst expectations now, the consensus is at 5.15% for 2024, and Goldman Sachs has it as low as 0.8% in 2024. And if we take a look at their valuation metrics real quick, we see that their PE ratio is at the lowest levels it's been in 10 years. So really the main question is, how confident do you feel in their continued revenue and earnings per share growth versus what the expectations are? Now, obviously there are some legitimate concerns there, but at a minimum, I would expect a reversion to the mean for Hershey as it relates to PE ratio at the absolute least. But overall, I think there's likely a chance for a lot more than that once cocoa prices come down and share buybacks start ramping up again. So to me, the sell-off in Hershey is overdone, their headwinds are a bit overblown, and they have more than a few levers to pull to beat expectations, which are pretty low right now. Plus, let's not forget that Hershey's is a wide moat business with brands that people love, so I think they're going to have a really good 2024. Stock number 2, Valero. Now, Valero is currently 9% of my portfolio, and I'm up about 15%, price only, not including dividends, since I started adding it in April and May of 2023. Now, if we look at how they performed in 2023, Valero had a 11.88% total return compared to the over 26% total return of the S&P 500, but it tends to have pretty wide price swings. I started buying here at around 106 in April and May, and I watched it go all the way up to 145 in about 4 months. Now, it's come down about 10% or so since then, though. But let's talk about Valero's business. Valero is primarily an oil refiner, so their stock price is going to be heavily impacted by gasoline crack spreads. Now, crack spread is basically the margin for processing a barrel of crude oil into gasoline. So as gas prices come down, their margins come down, which means their revenues and profits come down as well. And you see that whenever the crack spread was the highest in June of 2022, it was also when Valero was at its peak, which coincidentally, it touched again in 2023. So it's a very cyclical business for sure, especially when you have political leaders trying to push down the price of gas all the time. But Valero is an extremely well-run business. They focus on disciplined capital management with a consistent range for CapEx. Rewarding shareholders with dividends and share buybacks is also a priority for them. So much so that they took on debt during the pandemic in order to continue paying their dividend, just not increasing it. But they were only able to do that because they had such a strong balance sheet to begin with. And they've since already paid back all that debt, and I would expect them to get back to their large dividend raises as we start 2024. Plus, outside of refining, they are a large renewable diesel and ethanol producer who's continuing to find ways to ramp up revenues outside of just the core refining space, because obviously there are long-term questions there. Now, if we take a look at a few of their performance metrics, we can see some other positive things. First, Valero has worked hard to improve their margins, and you can see that when you compare their current margins to their 5-year averages. And even though it looks like they're lagging their sector pretty bad, you have to remember that energy by itself is a pretty wide sector with a lot of different business types. Now, when you drill down into refiners only, Valero is about middle of the pack in terms of gross margin, but near the top in terms of free cash flow margin, which means that they're very good at converting revenues to free cash flow compared to their peers. Now, second, what they've shown is that they like using that free cash flow to reward shareholders. Obviously, they have a pretty decent dividend yield at over 3%, but they've also spent almost $6 billion on share buybacks in the last 12 months, which is about half of their cash from operations number. And you can see that over time, they've stopped buybacks during the pandemic, obviously, but then quickly ramped them back up as soon as they had excess cash flow. Now, in terms of valuation, Valero is just at a ridiculous level right now by traditional value methods. Obviously, a lot of this has to do with energy stocks as a whole because the whole industry is down. But Valero is at a PE ratio of under 5 and a price to cash flow ratio of under 4. Now, when I plug their numbers into my discounted cash flow spreadsheet, even with assuming a zero growth rate in perpetuity, it's still well above the price it's trading at today. And even compared to their historical metrics, it looks attractive. Remember when I said they hit a high in June of 2022 when the crack spread was high? Well, they were at a 20 PE at that point in time. When they hit that price again in September of 2023, they were at about a 5 PE. Now again, their business is volatile, so those earning numbers could come down a lot very quickly. But just from a pure value perspective, it looks very attractive. And not to mention that the earnings expectations for Valero right now are really low. Even if they match the low estimate for the next quarter, it would put their current price at under a 5.5 PE. And even if they hit all the expected earnings for the next 4 quarters, which I think are extremely low, it would put them at an 8.38 PE. And neither one of those sound outrageous to me. So even with lower expectations, I think there's a decent chance for multiple expansion here. So overall, obviously Valero is in an industry where there are questions, especially about the long-term viability of their business and regulatory and government-related changes. But this is a very well-run company, and I think the sell-off in energy and oil-related stocks is a bit overdone. Expectations for the industry as a whole and Valero specifically seem to be at a pretty low bar, which I think gives them a good opportunity to surprise in a good way. So to me, Valero, even at their current price of $130, looks attractive. Now, their stock tends to be volatile, so you have to understand that going in, and don't be surprised if it has some large price swings along the way. But based on fundamentals, I think it's poised to have a very good 2024. Stock number 3, Visa. Now, Visa is currently about 11% of my portfolio, and I have a modest 7.5% gain on it since I first added it back in August of 2023. Now, if we look at how they performed in 2023 as a whole, they've had a total return of 26.53%, which is just above the S&P's total return of 26.08%. And it's pretty interesting because if you look at Visa's performance since 2021, it reached a high of about $250 or so in July of 2021. And then it basically had been flat and down since then, up until 2023, where it started to go up again and move past that previous high in November. And we're going to talk about why I think that's important here in a minute. But from a business standpoint, Visa is really one of the most consistent performers there is due to their business model. And we've talked about them in detail before, but just in general, their revenues rise as transactions rise, as well as when prices go up. So they have inflation-proof revenues. They don't take any credit risk for their cards because they're just the processing platform and not the issuing bank, which means that they won't be on the hook if consumer credit starts to deteriorate. They basically operate in a duopoly with MasterCard. They consistently average over 10% revenue, earnings per share, and operating cash flow growth. They have ridiculous margins with a gross profit of over 97% and a net income and free cash flow margin of over 50%. And even though they have a low dividend yield of under 1%, their dividend growth averages over 15% on the 3, 5, and 10-year timeframes. Now, Visa is just a beast, and to me, they really only have a few material risks, which are A, MasterCard and maybe Amex taking a significant amount of their market share, which might be possible, but not a huge risk in my opinion. And then B, regulatory changes impacting their profitability, which is probably the most likely risk, but also one that takes a while to materialize and has quite a bit of lead time before it happens. And then C, people start using a bunch of cash instead of their debit and credit cards, which I think is highly unlikely. Now, I've said it before, but Visa is easily one of the best businesses that I've ever looked at. So to me, the question with them always comes down to valuation. And I want to go back to what I said at the beginning for Visa about how since 2021, they've basically been flat or downward. And you can see what's happening on the chart. In July 2021, they were at a high of about $250 a share. And at that point, they were at a 50 PE and about a $5 earning per share with about $24 billion in revenue. Now, what's happened since then is multiple compression for Visa because now they're around $250 a share again, but they're at a 30 PE with over $8 earnings per share and over $32 billion in revenue. So for the same price as you paid 2 years ago, you're getting 60% more earnings per share and 33% more revenue. So while in general, if you look at something at a 30 PE and say, oh, it's probably pretty pricey, I would normally agree with you. But with Visa, I would say it's as cheap as it's been since the pandemic in 2020, and their business is as good and profitable as ever. So overall, Visa is just a machine in a business that I just don't think has a lot of material risks that are very likely to happen. So even though the current earnings per share estimates are over 12%, which in general I would consider high, they're actually pretty tame expectations for Visa based on their history. And after a couple years of multiple compression, I think it's in position to continue its end-of-year run-up into 2024 and beyond. Lastly, stock number 4, Caterpillar. Now, Caterpillar's currently 4.5% of my portfolio, and I have a whopping 19.56% gain on it since I added it just 6 weeks ago, and that's because it's been on an absolute tear for the past month and a half. Now, if we look at how they performed in 2023, they had a total return of 25.04% versus the S&P's total return of just over 26%. And again, it's in a similar situation to Visa in that it reached a high of about $245 or so in June 2021, and it basically had been flat and down until early 2023, where it started going up again, and it's been a bit volatile, but overall trending back up throughout the year. Now, I just did my in-depth analysis of Caterpillar a little over a month ago, but from a business standpoint, there's a lot to like. They have strong revenue and free cash flow growth. They have a wide moat business. They have geographic and industry diversity in their business model, and they have increasing margins. And even though there's some uncertainty with global conflicts, fiscal policy concerns, and an upcoming election, I still think Caterpillar is likely to beat analyst expectations in 2024. Now, currently, the consensus estimate is flat to negative earnings per share growth, and ultimately that could happen because they had a really good last 3 quarters that handily beat expectations. But Cat's management team is still optimistic in 2024 based on their comments and earnings calls. They see multiple areas that are strong that think will lead to a very good upcoming year, including government infrastructure investments that started in 2023 but will ramp up in 2024, residential construction that's still growing but just at a slower pace, oil and gas, solar turbines, and gas compression demand is still strong, as well as power generation demand and data center construction growth. So I think the business outlook for Cat might be a little better than those current expectations. But in terms of valuation, you see a similar thing that we saw with Visa. Back when they were at $245 a share in June of 2021, they were at a 38 PE and a $6.25 earnings per share. And now they're at a 16 PE with over $17 earnings per share. So again, it's not like we should judge everything based on 2021, because as we know, that was a really wild year as it relates to valuations. But it just shows that some of these companies that ran up a lot during the pandemic have been going through multiple compression for a while and are just now breaking out of it. So overall for Caterpillar, I just feel that the analyst expectations for 2024 are just too low. And even with the run-up, the value isn't outrageous. So if their business outlook is even slightly better than expectations, I think we'll have a really good 2024. And so those are my top 4 stocks for 2024. It'll be interesting to revisit this throughout the year and especially towards the end of the year to see how they did. So what do you guys think of my list? Did you have any of the same stocks on yours for 2024? Let me know down in the comments below. Now, if you're new to the channel and you want to see more deep dives on individual stocks, especially the 4 that I talked about in this video, click on this playlist right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.